The Hedgeless Horseman here. It's December 29th, 2023. Almost a new year. First of all, thanks to sponsors. Let's dig in. So there are a few things I want to talk about. This will be more of a, I guess, copium investing strategy kind of thing. And also I will touch on selling. I repeatedly get asked about when to sell, but first things first. Okay, so we just ended the tax loss silly season, where you have people who sell stocks that they are down on in order to offset those losses relative to some gains, let's say. So meaning that, which makes this sector very interesting, or I guess the stock market overall, but especially this sector, since this is the sector that is, spends most of the time in a bear market and have short, violent rallies. So you're often gonna have tax loss selling reasons, because you're gonna be down on a lot of stocks come December. And of course, since it's also a very hard sector in terms of success, what I mean by that is, here everything went up, here pretty much everything went up, here pretty much everything went down here. But it's also the fact that there are a few projects that actually work out really well, or especially work out enough that they offset the dilution during the bad times, if you know what I mean. Because there's plenty of juniors out there that have been, they've grown their resource over this time. So they've added value. And if they're a gold junior, gold is not, it's over 2,000, so you can't really say that, well, they didn't create value because gold was down to, $1,000. Yes, they added ounces, but those ounces are now worthless. No, you can't say that really. So that's what makes this sector extremely misleading, in the sense that at any particular time, nothing really makes much sense. Because a company can go up 50% or down 50% without much having changed. So it's extremely chaotic. And then you have stuff like, tax loss silly season, where it's like, you think, well, this stock is real cheap. Let's say you bought it in September or October. And it, keeps going down. It just keeps going down. And typically, one thing I think a lot of people make in terms of mistakes is that they are too fixated on paper profits, paper losses in any particular time frame. Because I think a lot of people need to look right in order to believe they are right. As soon as they start seeing paper losses, they think they have done something. They've done a mistake. Because that's what everybody seems to be brainwashed to believe, that you should really only have short-term corrections. And if you're doing something right, you should be making money almost every time. I think they need it as an reinforcement that they are doing something right. The market should be rewarding you all the time if you're doing something right. And what does that stem from? Do I have a big problem seeing big paper losses? No, I see big paper losses all the time. Do I have a problem that's like, well, I'm down on a stock? Well, let's say a stock has gone down for like a year or whatever. How easy is it to think that, well, actually I'm still right? It's just the market that's been wrong for a year, underestimated the company for a year. It's very hard for people to do that if you actually believe that the sector is rational. If you think the stock market, especially the junior sector, is rational, then you start by default to buy into its bullshit. So meaning that down here, of course, when you have this as recent past, you must have been doing something very wrong. but that's the funny thing when the a hold, let's say you hold it down here. This is the time where you look the most stupid, but where holding would be the most rational thing to do. Of course, we learned that in hindsight. Because sell, if you hold down here and sell, that's the worst mistake you can do in this time frame, right? Because it went up hundreds of percent later. So it's the worst time to sell if you held all the way down. But it's also the point which you look the most stupid for holding. Which again, I think this is what makes investing, especially in a volatile cyclical sector, kinda difficult, because you're gonna look the most stupid and want to do something when it's the worst thing to do. And the thing is, we have New Year coming up, and typically companies, if they don't get some news out before, let's say, Christmas, and of course, companies tend to not want to put out positive news if they think there's nobody listening, there's nobody that's even risk on. I mean, even if people saw it was good news and the company knows they're putting out good news, if they think that nobody's going to reward us for this news, I mean, that is huge implications. Imagine you put out good news, stock is up 30%, get some groove going, gets a trend going. People, like always, who use the share price as an indicator if something's going good or bad in any time frame, they will start to feel comfortable. They weren't comfortable buying it at lower prices because the market was, telling them, they're eating up the market's bullshit, telling them that this is a story that's getting worse and worse on a weekly basis. So they're not buying that. After it goes up, I mean, that's what people tend to do all the time. I mean, they are much more comfortable buying higher than lower. And I mean, that's typically what traders, what they do. I mean, they join the herd. As a value investor, your thing is to go against the herd. And I don't want to call it contrarian, because I just think I think the perspective is do you need to be a contrarian to buy something cheap? I mean, cheap in itself is the reason, not that nobody or that everybody else is selling, if you know what I mean, even if they go together. So I don't look at myself as a contrarian. I don't think I need to think like a contrarian just to buy something cheap. It's self-evident. If it's cheap, it's a buy signal by default, not that it's a need for other people to just say it's a sell, if you know what I mean, even though that's what they're doing if they're voting with their feet and selling. But the thing is, okay, where are we right now? I mean, we just ended tax loss silly season, where you have artificial selling pressure. You have asks that wouldn't be there if it wasn't for the fact that they could use the tax write-offs. They wouldn't sell, they wouldn't hit the bid at these levels if they didn't have tax reasons. So you have artificial shares or artificial reasons for even more people selling shares. And you also know that, well, in the new year, companies that haven't put out, if they have positive news and they were ready to put it out in the last month, they might not do it, or at least the last 3 weeks. They might hold off for the new year because they think that, hey, okay, if there's still selling pressures for tax reasons, that's going to subdue any positive reaction to our positive news. And that's going to, like always, influence other people, because if they see a news item being put out and the market doesn't react positively to it. People will think the news item wasn't positive, so they shouldn't buy. If it went up, then they would buy, because then, the market says this was a good news release, and then they buy. And the funny thing is that what typically happens is that you kind of buy in when it's perhaps priced in already. If you're always waiting for the market to the let's say smart money, or the people that are earlier than you wait for them to buy up the stock, so you see the positive price move, and then you buy, because then you think, well, okay, it was a good news release. But it's like, well, as a value investor, you obviously want to buy if the news is positive and the stock doesn't move. That's a bigger buy than if they put out a positive news release and the stock is up 30% when you feel comfortable enough to buy. So I mean, if we're honest with ourselves, and it's like I make mistakes all the time as well, there's an endless list of things we could get better at. Be more rational. People, it's like, I'm gonna take this person for example. This was posted today on a post on Magna's review letter from the CEO, which I think was a very good letter by Jason. Anyway, the comment was, back to my purchase price at 40 cents, I'm out. Sold all my Magna mining stock today, divesting portfolio of all juniors. Worst investment sector possible. If it was a matter of waiting for higher prices, that's one thing, but the relentless dilution is a killer. Good luck to all. Does this make sense? Does this look rational? And of course, I mean, he could have just went away and not post anything. I mean, let's say I'm not bullish on a stock or whatever. It's like, you probably won't see me being active there. I don't need to tell people. It's like, I've sold. Why do people do that? Of course, it's that, I mean, subconsciously, if nothing else, he's not super sure he's doing the right decision. He would prefer, I mean, his nightmare would that Magna would be going up the day after he sold, obviously. Because then he's gonna look stupid. And people don't want to look stupid, they don't want to feel stupid. We want to feel like we want to feel successful. That's just how it is, and that's also why I think that you really need to be able to handle big paper losses, looking stupid, and long periods of time, looking very stupid over a long period of time. Because if you can't handle that, if you don't know enough what you're doing, let's say, you'll start to believe the market is bullshit, and you're gonna think you're stupid, you're doing something wrong, and that's not a feeling people want. So they rather just get out, to not be reminded that they are stupid, if that makes sense. And the reality is that you can have people who are up 100% this year who are shit at investing, really. You can see people that are really good at investing be down 50%. A year is really nothing in investing. Even though that's not how people see it, because typically it's like, if you go to the gym 3 times a week over a year, if you haven't gotten a bit more in shape or lost weight or whatever your goal was, obviously you're doing something right. I mean, pretty much by default, because there's a direct causation there. If I spend more calories than I take in, I should be losing weight. If you don't, you're doing something wrong. Investing doesn't work like that, for better or for worse, because there is so much noise, even on a yearly basis, and especially in this sector. Here we have a fat headwind. I saw some guy on Twitter, he was complaining about this sector, and he was I think he said that he started buying like 3 years ago or something, which is the typical start for most people. Buying in at the highs when people have made money and you think it's a good sector to be in. People don't rush into a sector that people have lost money on paper, because that's telling them it's a bad sector. So I would guess that 90% of people, their first entry into any sector, stock market, whatever, it's near the highs. Because they see people make money, they've heard people make money, everybody agrees that they're gonna still be making money, everybody looks smart, they have missed out, they want to look smart, they want to make money, so you get in here and then you sell out here, which is, I mean, kind of what it looks like Ryan here is doing. But anyway, so this guy, he said, I thought they were cheap, but I'm break even this year, for example. I mean, this has been, 2013 has been a pretty shitty year. I mean, if we just take this Bear Creek as a proxy, it's like we've gone from here, here to here. And this is just, I mean, Bear Creek Mining might be punished more than most of the other companies, but I think if you're break even this year, that's, I would say, huge outperformance. The simple logic behind that is, imagine whatever, let's say you started here. Let's say if you're down 50% here. Was that a problem? Absolutely not. You could be down a lot more than 50%. If you're down 50% here, is that a problem? No. So, I mean, you have to just kind of accept how dumb the market is. How little sense it makes on a short-term, medium-term basis. If you know the sector has gone like this, and you think, oh, I must be stupid for having paper losses on a lot of stocks, it's like, then you don't even understand how the markets work. I mean, that's how silly this sector is. Here, everything went up. Here, almost everything went down. That's just how it is. That's a cyclical sector. If you're down 50% in your portfolio right now, I don't think that's a problem at all. 60% probably not a problem, 70%. But that doesn't mean that's like, okay, if it's not a problem, I'm just going to hold on to whatever stock I have, yada yada. I mean, the basis is that it's like in my situation, for example, I don't own the sector, I own individual companies. Micro first, in my opinion. Yes, everything is gonna go up if when the next bull comes. Yes, that's a given. Crap will fly, everything will fly. The crappier it is, the more it will fly. But I don't like holding crap. I don't like. Back here, I was kinda lucky. Yeah, all I knew it was that this sector was cheap, and I bought some stuff that was down 95%, and then they went up several 100%. I had the right idea, but like nowadays I can't stand owning crap. I want to feel like the shares I own are worth something, not just that I'm gonna flip this crap to someone else at a higher price. Because if you own a lot of dog shit companies, I don't think it feels good knowing that my money is invested. I own an interest in a lot of crap. That doesn't feel good, because like intrinsically one could say I have bought a lot of coal with my money and hoping that someone will buy my coal at higher prices. I just don't like that. That's not my cup of tea. But okay, going back here, and I don't know if it's the same person, but here's like someone in the Magna form as well. Oh, sweet, I just discovered I broke even. Next training session I'm out. You all can have my shares. And this is the short of Magna. I don't know when this guy bought in, if it was here or there or whatever. But he's leaving, I guess, the sector, especially if it's, you know, this person. I mean, does that make a lot of sense? Does he deserve to make money long term? Do you see any problems with this? I mean, we don't know exactly how he went about things, but if we have the sentiment of or the Bear Creek as a proxy, he's basically selling all my junior portfolio here because he thinks you can't make money in this sector. I mean, of course you're not going to make money in this sector if you sell down here. This is I mean, this sector has not been this cheap for a long time, or in a lot of occasions over the last like 20 years. Is it because you can't make money in this sector, or because you can't make money in this sector? And if we take Magna, for example, if we were just strict, let's say, value investors, let's say he bought in here. Okay, I mean, that's perfectly fine. I bought a shit ton here as well. But it sounded, and I'm not sure, it's like, let's say you do absolutely nothing all the way up, all the way down, and then you sell when you get back to even. What was the plan, really? It sounds like the plan was, I'm buying this, hope I'll make money, not thinking of, I don't know, you know, price to value or anything like that. It's almost like a blind shot. It's like, I'm buying this. When it went up, I didn't take any profits because let's say I don't know what the value is, I don't know what the price is or anything like that. So you don't sell when it goes up, and you don't buy when it goes down. You sell out when you get to break even. Is that even a strategy? That just sounds like I bought, I'm not sure why I bought. I have no idea how to handle volatility. And instead of, like, for example, taking some profits up here, if you're up 120%, you don't sell anything because you expect it to always go like that. On the way down, I don't buy anything, and then I sell out if I'm break even. I mean, obviously that's a psychological thing. It's like, when he breaks even, I'm out. That is the hallmark of I was gonna say, that is the hallmark of not really knowing what you're doing, how this sector works, and what I meant by, price. It just feels better if you can get out at least even. It doesn't look like that much of a mistake in that case. I see that all the time, and I have some friends who used to do that. They're like, no, I'm down on this stock, but I'm gonna sell when when I break even. It's like, why? Because you're not gonna feel that stupid, so you're gonna wait, for an eternity to just break even, so you never have to take a loss. So you can no, someone asks you about the stock or whatever, I can at least say I didn't lost money. I mean, it's more of an ego thing in that case. I don't have much problem selling something that I'm down minus 50% if I can buy something that I think is gonna, over the next years go up 300%. This is the stigma I'm trying to get out of people. That again, if you think you did something terribly wrong if you're down over this period, you don't understand how this sector works. If you think you're super smart if for whatever reason you bought here and held up there, I mean, was I super smart because I made a lot of money in this rally? No. The only smart thing I did really was to buy when it was cheap. I had no idea when the bottom was going to be in. I just bought the cheaper it got. But you can ill afford to start buying here and selling out here. But that's why this sector is probably not for most people, because if you need constant reminder, you need to be told by the market that you're a good boy. You're only gonna average up. You're gonna buy high. You're gonna average up. Then you might sell low or sell when you're break even, and totally misplay the whole cyclical nature of this. Because as you can see, there's no mention, and I've said this, I don't know, 1,000 times before. There is no mention at all about I'm selling because I think they are overvalued. It doesn't. My strategy is saying it's overvalued. No, basically this is signaling that this was for ego reasons. Okay, now, you know, if I sell, if I'm break even, I don't feel as shitty. But I'm not going to sell when I'm in the red, because that's going to look stupid. Divesting my portfolio of all juniors. It's like, I'm not surprised at all if you can't be doing this stuff if you want to have any hopes of making any money in the markets overall, but a cyclical sector. And then, you know, the copium, if it was a matter of waiting for higher prices, that's one thing, but the relentless dilution is a killer. That's a blanket statement. If it was a matter of waiting for higher prices, that's, I don't understand what he's talking about. I guess he means that, okay, gold is up and the juniors are not up. But that's the funny thing as well, because if gold is up and the gold juniors, for example, are not up, that just means they're that much cheaper, which is less of a reason to sell and much more of a reason to buy. But he's doing the opposite. But the relentless dilution is a killer. And he posts this on Magna. It's like, has Magna, done relentless dilution? No. So that's the interesting part. It's like, the reasons he gives makes no real sense. I mean, waiting for higher prices. I mean, we are waiting for higher prices. But I guess it didn't come quick enough, because it sounds like, well, we're down here. Obviously, prices haven't gone up yet. And it's like, nobody knows when the prices are going to go up. But he's basically saying, I mean, you have three things going here. You have ego preservation, getting out at plus minus zero, so you don't feel as stupid and don't look as stupid. Okay. Which is weird. I mean, I'm investing to make money, not investing to preserve my ego. And if I'm down, I'm just waiting to get out and put my tail behind my legs, so I don't feel as bad. And that's the only reason to get out at, plus minus zero. You just don't want to feel stupid or look stupid. And you have waiting for higher prices. I mean, that's the thing. Nobody knows when I mean, some of the juniors are, not down here. I mean, they're up a bit. The bull market might already, it's like if you look at GDXJ or whatever, the new bull market might have started a few months ago. But nobody's ringing the bell. We're going to know if we're in a bull market. I mean, up here you knew we were in a bull market. If it went up there, nobody could say it was a bull market. I mean, look at this fake out. Went over a lot of previous highs, higher low as well, boom. Nope, wasn't really a bull market. Same here, nope, wasn't the start of a bull market. Nope, wasn't the start of a bull market. Nobody knows. Except for hindsight. Up here we know this wasn't a fake rally like this. In hindsight. When almost all the money has been made already, then you should have been in months ago. Yeah, but the relentless dilution is a killer. Again, it's like, let's say, taking no responsibility. how if this is the reason you think, again, it's the sector's fault. It's not my fault. It's the relentless dilution. What? So I mean, it's like it's a universal law. It's not like, oh, hey, there's like 1,700 stocks out there. I could put a lot of work in to find the ones who have money or have get good access to capital, nice share structure, strong backers, good management team, skin in the game. What? No, I'm not going to do that. I'm just going to say it's the relentless dilution. Because again, then that's ego preservation as well. It's not me, it's not me doing anything wrong. It's not me selling down here that's the reason. No, it's the relentless dilution of the sector, and that I waiting for higher prices, and then I sell out at plus minus when I'm back to my buying price. None of that is rational. That's I mean, I'm not saying it's an easy sector, but when you see why people lose money, I mean, then I hope people start to get it. Because again, it's not the bear markets, it's not that this sector went down here that is the reason why you can't make money. It's what people do when the volatility comes. These are the best places to have bought shares. And people sell, and then they say it's the market's fault. That's just bullshit. It's you did this to yourself. That's why most people should probably stick to indices. It's like I can understand him. I mean, we can understand him because it's very human to not wanting to look stupid, to not having the patience that, okay, let's say this sector starts a monster rally tomorrow. Then if he had patience for one more day, then it would be easier, because obviously it's going to feel easier when things are going up, even though when they're going up or nothing but sentiment change, that means the opportunity is getting worse. But it feels good. It feels good in the uptrend. Because you look smart. That's the thing. You look smarter and smarter the higher people buy. And you look dumber and dumber the dumber people are selling lower and lower. So if your ego is tied to your paper profits or paper losses in any particular, then you're going to have a very, very, very hard time to make any money in a sector that gets this batshit crazy. The big play in this chart is that juniors are cheap. I don't care where gold is, if it's 1,800 or 2,200, they are cheap right now. If gold goes up 100%, $100 down $100, they're still cheap. The big opportunity here is to wait for the next sector bull, which is 100% guaranteed that it's going to happen. Every single bull is followed by a bear. Every single bear is followed by a bull, and followed by a bear, and followed by a bull, and followed by a bear, and followed by a bull. 100% guarantee. 100% guaranteed. This is the Barron's Gold Mining Index over 100 years. Sure, there's been a lot of different companies here. Do you see any trend here that is permanent? Did this go up forever? Did this go down forever? Nope. And again, if you just had, you program something, you just use this mining index, like as soon as this index is down 50%, I'm going to buy every month. And if it goes down more, I'm going to add 10% to the buying amount, whatever. So you're going to do an exponential buying increase the lower it goes from 50%. You would have made money every single time. Because even if it goes back, if you start buying here and ramp up the buying, your average might be here. So even if you're barely up from where you started, you would still have made pretty decent money. Same here. This didn't even reach this top, but if you started buying here, exponentially increase the buying down here, your average might be down here. So when it's back here, not even above the previous top, you would have made money. And of course, like, this is a hard sector to sell, so I'm a stock picker anyways. That's the thing. It's like micro first. I see a lot of people. They have, I mean, some actually have, I think, pretty decent portfolios, but it's like some. I guess it's the especially silver bulls. I think they own a lot of crap, basically, and it's like, yeah, crap works if they don't get diluted to oblivion first before the next rally comes. That's why I don't like pure beta plays, especially if it's a marginal project and especially if they're doing work in diluting. If you have a big project and the company is not spending much money, so there's not much dilution, they're just sitting on their hands, I mean, that would be one of the better beta plays. I mean, if you have something that's like on paper, oh, it's, 10 million ounces, the market cap is, let's say 5 million ounces, market cap is 30 million. It's going to cost them 30 million to add 2 million ounces, whatever. Their entire market cap in dilution at these levels just to add 20% to it. It's like, is that worth it? I don't think it's worth it. It's not going to change. Well, I shouldn't say 20 million. 2 million. Let's say 1 million more. 5 to 6 million ounces. Is that going to materially change the project? Probably not. But if you dilute it, you take away half the upside for a 20% gain in value. That doesn't sound, like the best beta play if the company decides to be that aggressive. That's where the due diligence comes in. And, I like this graph to just highlight. So, this is how I look at value shuffling, let's say. There's around 1,700 junior share stocks, I think, out there, companies. Their prices might change on a daily basis. Let's say this was a sideways market or whatever. Not every single company moves in tandem. Here you have, let's just, for whatever reason, let's have this yellow line here. That's one company. Hasn't done much in terms of news. And then you have this red one here. This one went down, this yellow one went up. And let's say value didn't change that much. But for some reason, there's more buying in one or more selling in the other, and they diverge. So all of a sudden, this yellow one might be cheap still, but it's not as cheap as the red one that went down in price. Volatility is the cheap man's currency, or the poor man's currency. Volatility is the best tool we have. It's because of this volatility that you can make money in this sector. But it's the main reason why people don't. This was volatility. One could say, okay, I don't think Magna was expensive up here, but let's say it was less cheap than it was down here. Okay, so if you think it's less cheap up here than down here, and you held your entire portfolio, ideally one should have the highest percentage in terms of position size when it's the cheapest. And it should decrease when it gets more expensive or less cheap. And the opposite is true as well. If it gets cheaper, you should have a higher exposure. That if you have just that value, price to value mentality, you will naturally phase out or shed shares when it reprices and the price to value gap closes, and you would do the opposite on the way down. Because people ask me about selling. I'm very bad at selling. I sell something when I find something cheaper or what I have, and it might be cheap still, but it's just the positions is too large. I'm not, if I find the cheapest stock there is, I think Magna is one of the cheapest stocks there is, I'm not going to have 100%. Things can go wrong. Things can happen. So even if you think something is the cheapest, there's a reason why you don't go all in, for example. But what has really changed for Magna? they're closer to, I mean, depending on the environment, let's say, and nickel prices, yada yada. I mean, they have never been closer to potential production than they are now. They are much more advanced here than they were here. I would say magna is much cheaper here than it was here. So in this case, let's say Ryan, he bought here, but he's selling when it's even cheaper. In that case, he shouldn't have bought at all if back here. I mean, yes, there's been some dilution and market cap is a bit higher, but they have 50 million in cash or something like that. Much more advanced. They had real success. I mean, we know they have a lot more now because they drilled it, even though it's not in a resource yet. They have a PA out and stuff like that. You have the critical minerals initiative, yada yada. Sure, nickel price are lower, but it's like, I would say it's probably a better buy here than at the same level like, what is it, a year ago. And that's what I mean. It's like, there is no real logic behind this. And that's why, if this is the logic he uses, he's not going to have a chance in this sector. That's just how it is. So it might be best for him to simply, okay, I can't deal with this sector. I'm going to go to index investing or something. And that's the correct answer for most people. That is the correct answer. Most people don't have the temperament, the patience, the time to do due diligence, etc. But everybody expects that, no, everything should be easy. You should just be handed stuff. But like, you cannot afford to do stuff like this. You cannot afford, in my opinion, to be to buy up here, let's say, and sell down here. That's just not okay. You don't have a good investing strategy. Because there's not a hint of his investing strategy here. Not a hint. So he might not even, again, know at all really what he's doing, except he bought and thought that they should go higher. I don't know why, but they should go higher. But when they go higher, he doesn't do anything. When they go lower, he is happy to leave this stock, for example, when it's plus minus zero, because it's not going to feel as bad. But that is this is not okay. I mean, you should not be in this sector if this is your mentality. You have no chance, I don't think. And then of course we have the thing that I know, some people like, you shouldn't, average down is not typically something you should do, yada yada. But it's like, everything, there's context to everything. I don't buy I don't average down in every single stock just because they're down. There's some stocks, let's say I'm down 50%, and I actually think they're more expensive now than they were before they went down 50%. There are other stocks where, I mean revenue, we can substitute this with fundamentals. Because in my opinion, as a value investor, you have a problem if you bought it higher than the value curve, let's say. If you bought it here, you overpaid for the time being. But if it's a growth stock, the idea is, because they're always going to be expensive, that you hope to have success, so this is going to look cheap one day. But if you overpaid and the fundamentals have gone bad, I mean, again, it might be more expensive if it's down 50%. Some companies might be much cheaper when they're down 50%. So it's not like anytime I see something that's just down 50%, it's like, oh, that's a screaming buy, it just get cheaper. No, it depends on what has happened with the value. If Magna, for example, had gotten a lot worse, if we believe that the value curve was like this, let's say we believe the value curve went like that, and the market was totally rational all the time. So it followed the value curve. Value went up. It was fairly priced all the way up. It just kept tracking value. Then something happened, so they started, undrilling ounces, or something like that, then this chart will make sense. Otherwise, it doesn't make sense. Because I personally don't think value went up like this and then down like that. That's a big difference than if, I mean, let's say value has gone like this. Let's say it was cheap here. Let's say it overshot. Okay, you start to form a trend, and you know how people are in trends. Trends make them sell even lower. The stronger the trend, the more okay they are to make even bigger mistakes. And then you have, you know, there was warrants at 40 cents, which makes sense. Okay, if people are scrambling to eke out some kind of profits. I mean, if it's at 47 cents, okay, they have a 7-cent return on their warrant. So they're cashing in. They're converting warrants selling. That's artificial selling pressure, if you know what I mean. And we have tax loss silly season. What happened? I mean, maybe the tax loss selling ended here. Maybe the warrant holders have sold out already. Maybe there are no more 40 cents warrants that's going to be converted and sold immediately into the market. So it's like there is so much noise in this sector, which makes price go bonkers at times. Has nothing to do with the company fundamentals at all. It just means, in this case, let's say artificial selling from warrant holders, artificial selling from tax loss silly season, and all of a sudden you have a cheap that is stuck at dirt cheap gear. All of a sudden maybe that's gone, and it's like the same stock without news. All of a sudden it's up 34%, was up 54%. So I mean, if you believe the market's bullshit all the time, oh, it must be stupid, it's down here, oh, Jesus, everything is gone worse and worse, you're going to be selling out there. But if you call the market's bullshit, and it's like, I don't care where it's going in the short term, this is just cheap. I mean, in a year or two, I think this is going to look cheap. You just buy. But that's also a big reason why you have to have longer time frames. That's I think a big culprit for why people lose in this sector. They have a time limit. I remember back in, I think it was 2020, I was thinking like, maybe I should buy a new apartment, and then it got cheaper. And then I thought, it's already getting too cheap, and we're down here. Did I foresee that? Did I think we were gonna hit this level? And it's like, if somebody asked me, gold is gonna be over $2,000, the junior sector is gonna be down here. No chance I would believe that. It's like, that's beyond the realm of possibilities as I saw. But it happened. But I don't try to predict stuff like that. I can only take advantage of what the market gives me. If the market decides to be crazier than usual and brings assets down cheaper than warranted, a lot cheaper than they should be, I only have one response to that. By default, I gotta buy more. So I'm not keen on selling any juniors right now because they are the cheapest they've been since 2015. That's it. If we were up here, I would be much more happy to sell some juniors and buy a new apartment. There's no way I'm doing it down here. I would have wished for it. I mean, at the end of the day, if we get us decline like this, I think I'm gonna end up making even more money. And I pointed this out before. I mean, let's say we hit a sentiment high in, well, let's say 2025. I'm just guessing here, but it's like, I'm gonna make more money if it didn't go like that. This is gonna feel better because people would have way less paper losses if the sector turned around here and climbed up there. Not a raging bull, but a bull market nonetheless, than how it went here. But I am value shuffling and buying more every month. If it goes back up here later, if this is the way the market turns, I'm gonna make a lot more, because we had a big bear market in between. Because again, let's say I had 10,000 invested here. And I'm going to get 167% return. So 26,700. And hey, it's good. Nice. I let's say I didn't have much paper losses, whatever. It's gonna feel good. Hey, I'm making money. I'm gonna be making money over the next, let's say 3-4 years. And it's not the worst return, 167% over 3-4 years. It's pretty good. I mean, it's more than the broader market does, and it's gonna be a pretty smooth ride, let's say, because you never go into absolute depression levels. But let's say I take it back and I increase my buying here. So my paper losses are absolutely mounting. Let's say I had 10,000 here. I have 5,000 down here. But I add 5,000, whatever. So I'm back to 10,000 in portfolio value when it's down here. But I've taken a 50% haircut from here. I mean, even if it's less than that, if you have 5,000 here from your original investment and you add even 1,000, that's pretty good. Because if we would go back here, that's 1,900%. I mean, that's a run like this pretty much. And again, I'm not saying Bear Creek will be around. I don't have any idea if it would go up this much. That sounds a bit far-fetched, but I'm making a point here. So this right here felt a lot better, smoother, never looked really stupid. My ego was preserved. I was making a bit of money every year, but this is not enough for people anyway. So that's the fun part. Most people are gonna misplay this anyway. They're not gonna get 167%. But we had this big flush, and with a $10,000 investment, you're gonna get to 26. If I'm down here, and I have 10,000 invested down here, that's gonna be a lot more, obviously. 20 times, 200,000. So when you think about it, the best possible way to increase your long-term portfolio returns is to see a massive bear market with you adding money. If you didn't add, you would get 2,000% on $5,000. You just held it down, didn't add anything. And that's why I keep saying it's like there's a huge difference between selling, holding, and buying. The shorts, depending on what you do, again, it's not the bear markets themselves, it's what people do in the bear markets. If you sell, let's say you're down 70%, you sell out, I mean, you lost, I mean, you're down 70%, that's not coming back because you're not going to be part of the uptrend in any way, shape, or form. So let's say 3 people start buying here. One person buys here, sells down there. Okay, so he's going to be at a 70% loss. Let's say he walks away from stocks altogether. So from this time here to this here, 5 years, he took a 70% loss, never went back to the market. Okay, you have the guy that only holds, so he's down 70%. Let's say first, he's along for the ride up, at least, and that, let's say that's a bit of a higher ride. So he ends, at least this guy, the seller, minus 70%. Again, they started at the exact same place. They saw the exact same bear market. The seller, minus 70%. That's his long-term portfolio returns over 5 years. You have the holder. He sticks it out at least. So he's plus 167% after 5 years. Not the worst return, actually. Pretty okay. Then you have the buyer. He not only realizes you should not sell, he realizes that buying also has gone up exponentially. So he's buying. Okay. Sure, he invests a bit more money. That's how you really boost returns, because if you're not buying, I mean, you're not actively taking any advantage. So yes, he invests a bit more capital. So he's buying down there. His return, if he had 10,000, went down to 5,000, he adds 5,000 around here. But let's be a bit realistic. So it's not like he's bottom ticking, which is not needed. Let's say he does something like he manages to get his average down here. I mean, not everything. He doesn't invest all at the bottom, because nobody could expect to do that. But people try to do that, but that's just totally irrational, because there's no way you're gonna do that. So he goes down and then buys, so he has 10,000 again. So sure, yes, he has made a bigger investment, but on his 10,000, he's gonna get 810% on a $10,000. Well, I technically give $15,000, but it's like, I mean, I hope you start getting. I mean, it's just ridiculous how the returns will differ. Same bear market, same start. Based on what decisions these people do, one person over a 5-year period gets minus 70%. The holder gets plus 167%, which is pretty good actually. And the buyer, let's say he has 810% over that 5-year period. So can you really blame it on? And you can, I mean, you can take any bear market and you do the same thing. So it should be pretty obvious that it's not the bear markets themselves, but what people do in the bear market. It's their own fault for not doing enough work, not getting it, not doing enough due diligence, etc. That's why when I see people say, and they try to convince other people of it, it's like, I mean, he kind of left this comment because he hopes that people see it. It's like they're letting people know that I'm getting out. I hope you're getting out too, so I don't look that stupid. And he's gonna feel really good if for the next 1-2 months these stocks go down more. But that's the thing. It's like, it's not about the next 1 or 2 months. It's about the next big move. It might take 6 months. It might take a year or 2 years. But if it starts going down, he's going to be convinced that he did the right decision. So he will not get in and buy if it goes even lower. Let's say Magna, for example. Okay, let's say he gets out and Magna does this for whatever reason. He's going to feel really smart, going to be content with that, probably not look at juniors again because he quote knows he did the right decision. But then Magna goes like that. And somebody, a value investor, realized, hey, I thought it was cheap here, even cheaper here. So he would do like this person, just he bought more value shuffling or whatever. He's gonna get the last laugh, even though it's gonna look even more stupid for a while, but he's gonna get the last laugh. That's the thing. Investing is about maximizing your long-term returns. It's not about being in the profit every month, every year or anything. It's about maximizing the long-term returns. And if you're selling down here, you are absolutely not maximizing your long-term returns. And again, you can take whatever. Take this here. Wherever. Let's take this. You have a one that bought here, he's sold down here, minus 90% or more. You have a holder, he's still down, but yeah, he's down, I don't know, 70%, still less down. But you have a buyer, and even though this was the absolute worst bear market, if he sticks to his guns and he has a meaningful, he exponentially buys the cheaper it gets. At least, let's say not perfection that he is manages to add 1,000% to his portfolio down here, but at least like that. It's not the best return, but like still 5 years, let's say 132. That is actually decent at least, and that's if you start out with the worst possible buying, place to start buying. This is what I want to really hammer home. It's okay to start buying high at the worst possible moment if you start doing the right things afterwards. But this is too much for people. They get a really bad start, sit in a crappy market for years, and then they get convinced that this sector does not work. But let's say, yeah, okay, this was a mistake to like pile in here. But if you keep doing that, it's like, okay, research stocks, try to become better and better, and your mentality, you finally get it. It's a cyclical sector. The cheaper it gets, the more you buy. And the higher it goes, the less you buy. And the cheaper it gets, the more you buy and all that. And you do value shuffling. You become better at due diligence, etc. Risk reward, stock picking. Yes, if you would have played it perfectly, it's going to matter because that's how compounding does. But it's like, if you started off making a mistake, that's not justification to keep doing mistake. If you bought high here, which was not optimal, but that's easy to say in hindsight, but it was certainly not optimal. That doesn't give you a free pass to start doing even worse mistakes. If you bought up here and you think selling down here is how you remedy the situation, the mistake you did here, well, I got news for you. It's like you're gonna be the minus 70%. But if it takes 3 years for you to start getting how a cyclical sector works, you can make money for the rest of your life. Not every month, not every year or anything like that, but long term, because you're gonna have a portfolio sooner or later that goes something like this. Because you're gonna make less mistakes. Hopefully you learn even more and more so you get better and better. I think my investing strategy, I think, has improved a lot over the last 5 years. Back here I didn't know much. About money. I think I'm just getting better and better every year. Then we have other stuff like this is pretty. This is really the junior sector again. Days or even weeks or even months in this sector is kind of years as well, almost. Total chaos. You have no idea. You could have done everything right, but depending on where the sentiment swings, at one point you look smart, at one point you look stupid, whatever. You can't buy into the market's bullshit. If you think the market is wrong, you do something. Either sell or you buy. And that's the thing. Since it's asymmetrical and all of that, because when things get cheap enough, if you're wrong on buying, what's the worst thing that can happen? It can go down 100%. But if the market is wrong and it is way too cheap, you might get 500%, 1,000%. It's asymmetrical. It would be much harder if a bear market was, or the theoretical max loss was 100% and the theoretical max gain was 100%. Then we have a problem, but that's not how this sector works. It crashes, but then goes up hundreds of percent or thousands of percent sometimes. That's our main edge, that the upside is unlimited in a sense. Here is one of the hodl folios, for example. Does this look like, something you would go out and brag about? It's like, 3 years plus 48.3%. This is very low maintenance portfolio. No. I don't think many people would brag about this. But if we have the if we know how this sector works, people who know how the sector has been, it's like last 3 years. Wait, like what? Early 2021. Early 2021. Okay, almost at the highs. So this is the headwind you've been dealing with. The median juniors down 70% or something over the last 3 years. If you're up 48% over that period, that is massive outperformance, even though at face value it doesn't look that impressive. I bet there's people in other sectors, people keep talking about Nvidia. Nvidia might be up 300-400% over this period of time. But hey, that's okay. I mean, the thing is that when you think about it, and that's why, you know, people tell me, it's like, oh, you should never be full investor. You should only trade juniors. They're only good for whatever. It's like, think about it. If the sector's down here and you're up 48%, what do you think? How do you think it's going to look when we go into the next bull market, which we might already be in? My point has been, if this portfolio was down 50%, I don't think that's going to be a problem. So then the question is, and that's why I am comfortable being fully invested. If you can scrape by, the only real problem I see if you totally obliterate yourself. I mean, the worst possible thing is you kind of obliterate yourself and then sell. I mean, that's like the cardinal sins. But if you're down, let's say you're plus minus zero down here, man, you're gonna make a lot of money. If you're minus 50% here, you're gonna make a lot of money. If you're minus 50, 60%, I think you're gonna make a lot of money. If you're actually a bit positive, when should you not be in this sector in that case? If you can scrape by or even do okay in a bear, when should you be out? Because when this sector gets into a bull market, we're talking hundreds of percent, up to 1,000%. So there is no time, in my opinion, that I should be out of this sector. But also I would like to point out that, a few stories make a huge difference. I think this was a rally, this was mostly Magna, and this was mostly Magna. But in between, there's been Hercules, for example, there's been Snowline and stuff like that. So it's like a few stories can make a big difference. If this portfolio did not have, Magna is kind of back to where it started, but let's say I did not have had any Hercules or Snowline in this one. I'm trying to come up with if there was some other real standouts, but I think those would be the biggest standouts because they were big positions. Tectonic has done pretty well in this portfolio as well because I bought at like 5-6 cents or something, but still the biggest ones that outperformed plus were big sized was Snowline and Hercules, and you can't really see much of Hercules here actually. So I guess the rest of the portfolio went down quite a bit. So it doesn't again look that impressive, but it's like everything counts. That's why I care about even if I do a shuffling with 0.01% of the portfolio. Even if it doesn't feel like it's gonna matter almost anything at all, but I always want to have the best ahead for the portfolio. But if I didn't have Snowline or Hercules in this portfolio, maybe it would be minus 40%. That's how big of a difference a few good stories can do. And I don't think that would be a problem. But I'm grateful that's like, yes, Snowline did well. Hercules has done well. Magna, and that's the thing. I think Magna is back to the number one position again. Because Hercules has gone down a bit. Condor has gone down a bit, which is a fairly large one as well. but I think Magna is super cheap. So I think Magna might possibly be the one of the main drivers next year. So I don't see it as a problem. I see it as the market is borrowing money from me. If the stock is too cheap, it's borrowing money. If it's expensive, I overpaid, I owe the market. But I think every single holding has risk to the upside. And this is, I mean, I don't think this exactly goes with the mining sector because it's a finite sector. But overall, it's like, which stories are up the most percentage wise in this? Every single one of them is like the ones I have held for a long time. If Snowland, for example, it took time for, even if it's going to be successful, it takes time for them to drill up and find ounces. Again, even if you thought, hey, Snowland probably has 8 to 10 million ounces at Valley, they can't drill up that in a month. That's also that's what comes with time frame, and that's why I think it's so disastrous. Like if it was a matter of waiting for higher prices, it's like, well, you could have bought Snowline, you could have bought some of these Hercules, and those are only a few rare ones in a shitty sector. But what I want to get back to is that once you put in the work and make sure you don't get absolutely destroyed. If you sell out, there's no hope anyway. I mean, then you have given up anyway. But like, let's say you're down 70% here. The more you're down, obviously, the easier it is to average down. Because if you started with $10,000, you're down to $3,000. A $1,000 addition is a 33% increase. If you were down 90% here, I mean, let's say you started with 100,000 here, you're down to 10. The good thing about bear markets is that dry powder goes up exponentially in value. If you had 100,000, added 1,000 here, it doesn't change much. If you added 1,000 here, so you went from 10 to 11,000, I mean, that's going to give a pretty good boost. If you can put in $5,000, that's a really good boost. I mean, let's see here. Let's say you have 662. Oh, what's that? I don't have I'm just gonna do a quick 1 second. Okay, let's say you're down. You lost 90,000. You're down 90%. You add $5,000, so you have $15,000, and it goes up 62%. You are up to 114,000 at the peak here. So you're actually in the green. Even if you went all in $100,000, you write it down, so you're minus 90%, and you add $5,000 here. I mean, again, it can't be expected that like you bottom tick with a 5,000 whatever. But the point being that at least if you're down a lot, it means the sector is extremely bad. The more it has gone down, I mean the sector overall at least, the cheaper the prices. So your dry powder goes up exponentially in value, and if you're down a lot, it's easier to greatly impact the portfolio. if that makes sense. I mean, one could, if let's say you started with 1,000 per 10,000 here, you're down like 99%. If you scrape together 5%, 5,000, you'll make the 10,000 back even if it's almost erased, because the prices were so cheap that the future returns are so high. And of course, if we get into something like this, you don't need much addition. I mean, even if you started here and you're down 90%, if you invest a few $1,000s, whatever, that could become a lot over the next few years. That's the best offense and defense. Buying cheap. The worse the sector, the more impact of dry powder. Yeah, I mean, I hope you get something out of all this. But that's the important thing. It's like, again, I think this is not to, I don't want to, bash this guy. This is very human, but it's like, this is what we're talking about. This person, at times like this, he's, let's say you own 30 juniors, and you see 30 juniors end the day down today. And it's like, oh, that's probably a big problem. I mean, somebody's selling. What does the market know? It might be someone who simply threw in the towel, which is the most plausible reason, because I have no idea how one can be a value investor and come up with the conclusion I should sell here because they're overvalued. No, it might be someone who he got fed up. He might have started buying up here, and now he's selling all his juniors down here, and that's why you keep seeing selling pressure. And if you track, like, what's the motivation behind it, there is none really. He just wants to get out. He doesn't think you can make any money in this sector. So unfortunately, he proves that's the case, or it's a self-fulfilling prophecy. He thinks you can't make money because he hasn't made any money so far. And then he sells out, and cementing his loss, let's say, and join the majority of people which will buy high, sell at the lows, never come back. And because they do that, sell low, and the lower it goes, the more they sell. The ones who actually are the rare breed that actually buys and knows the next bull is 100% guaranteed, they can make a lot of money. Same sector, same bear, 3 people, different decision making, exponential difference in the future returns. That's just how it is. Either you learn long enough to get it and have the patience, etc., etc. Because that's why you see me a lot of time nowadays. I do a lot of memes with buy low and stuff. I know there's nothing else to do than wait. That's like 95% of investing. I don't do much. I mean I value shuffle here and there, etc. But I try to research companies, do due diligence, but most of the time I do absolutely nothing. I'm just waiting for the next inevitable bull. That's all there is. And I don't know if we have started it, if it's a day from now, if it's a week, if it's a year from now. But that's the strategy. That is the strategy, to capture the next big sector move. That's one thing you don't want to miss. And we kind of know where we are, and we kind of have an idea where we're going to go. It's just that we have no idea when that happens. All we can do is prepare and prepare and prepare and prepare. And in my opinion, make sure you'll be along for the ride. Thanks for listening. If I talked about any stocks, consider me biased. If there some might be sponsors as well, twice biased. And again, Bear Creek Mining, like always, I'm just using this as an indicator of the sentiment in the junior sector. I don't own Bear Creek Mining. I'm not saying it's going to go up 1,000, 2,000%. I don't even know if it's going to be around, but if it's going to be around, if it is around, it's probably going to go up a lot to the next sentiment high if they have not diluted or gone bankrupt before that. Thanks for listening. Not investing advice, all of that. Merry Christmas, Happy New Year. Bye.